Basics of cost accounting. Cost accounting is the classification, recording, and appropriate allocation of expenditure for the determination of the products or services and for the suitable presentation of data for the purpose of control and management. It normally includes the cost of job or contract, batch, process, and so on. Cost accountancy is the combination of both the application of costing and cost accounting principles, methods, techniques to science, art, and practice of cost control and ascertainment of profitability. This lesson introduces you with the concept of cost accountancy and its significance in your life as a manager. It follows from the previous slide that after studying this lesson, you should be able to define cost accounting, describe the difference between cost accounting and financial accounting, describe the key elements of cost accounting, explain the effectiveness of cost accounting. The main significance of cost accounting can be summarized as determining selling price, determining and controlling efficiency, facilitating preparation of financial and other statements, and providing basis for operating policy. Business enterprises run on a profit-making basis. It is thus necessary that revenue should be greater than expenditure incurred in producing goods and services from which the revenue is to be derived. Cost accounting provides various information regarding the cost to make and sell such products or services. Cost accounting involves a study of various operations used in manufacturing a product or providing a service. The study facilitates measuring the efficiency of an organization as a whole or department-wise, as well as devising means of increasing efficiency. Cost accounting provides daily, weekly, or monthly volumes of units produced and accumulated costs with appropriate analysis. A developed cost accounting system provides immediate information regarding stock of raw materials, work in progress, and finished goods. This helps in speedy preparation of financial statements. Cost accounting helps management to formulate operating policies. What is the difference between cost accounting and financial accounting? Cost accounting establishes budget and actual cost of operations, processes, departments, and the analysis of variances, profitability, or use of funds. Cost accounting is used to support decision-making to cut companies' costs, while financial accounting is concerned with the preparation of financial statements for decision-maker such as shareholders, banks, suppliers, employees, owners, and other stakeholders. The scope of cost accounting could be classified into three major segments, viz. Cost ascertainment, cost accounting, and cost control. Cost ascertainment highlights the linking up of the production with various expenses involved in the various stages of manufacture. The linking up of the expenses involved in the manufacture with the production is subject to the system, methods, and to techniques. Cost accounting is the process of accounting for cost, which begins with recording of expenditure and ends with the preparation of statistical data. Cost control is corrective measure action at the executive level to tune the actual with the standards which were set already. The methods of costing are normally classified into two major categories, that is, specific order costing and operation costing. Specific order costing pertains to the specific job or work which is normally entrusted upon the industry to complete the entire process of manufacturing. Under this type of costing, specific cost of the jobs, contracts, batch can be ascertained to the tune of their own nature and characteristics. Operation costing is more applicable in the case of products which are normally manufactured as well as expected to come across many stages of production process or operations in the industry. Techniques of costing are nothing but vital tools of ascertaining costs. Uniform costing is the use of same costing principles and practices by several undertakings for common control and comparison of costs. Marginal costing is another tool of costing. by studying the difference in between the fixed and variable cost in order to determine the influence of change in the level of output on the cost per unit. Through historical costing, the costs of the yester horizon are ascertained. Direct costing is the practice of charging all direct variable and fixed costs which are in relation with the operations, processes, or products by leaving all other costs which are normally written off against the profits. Absorption costing includes the fixed cost of operations along with the variable cost of production. Standard costing is another tool of costing which normally facilitates the firm to determine the deviation in between the actual and standards in order to exercise the control of deviations through corrective measures. The costs are classified into various categories according to the purpose and the requirements of the firm. According to functions, the costs are classified into various divisions or functions of the enterprise, that is, production cost, administration cost, selling and distribution cost, and so on. Direct costs of a cost object are related to the particular cost object and can be traced to that cost object conveniently and in an economically feasible way. Indirect costs of a cost object are related to the particular cost object but cannot be directly traced to that cost object in a convenient and economically feasible way. A variable cost changes in total in proportion to changes in the related level of total activity or volume. A fixed cost remains unchanged in total for a given time period, despite wide changes in the related level of total activity or volume. Cost which can be controlled through some measures known as controllable costs. All variable costs are considered to be controllable in segment to some extent. Costs which cannot be controlled are known as uncontrollable costs. All fixed costs are very difficult to control or bring down. Normal cost is the cost which is normally incurred at a given level of output in the conditions in which that level of output is normally achieved. Abnormal cost is the cost which is normally incurred at a given level of output in the conditions in which that level of output is normally attained. According to time, the costs are classified into historical costs and predetermined costs. According to planning and control, the two major classifications, that is, standard cost and budgetary control. While standard cost is a cost scientifically determined by the way of assuming a particular level of efficiency in utilization of material, labor, and indirect expenses. A budget is a detailed plan of operation for some specific future period. It is an estimate prepared in advance of the period to which it applies. The major classifications are sunk cost and marginal cost. Marginal cost is the amount at any given volume of output by which aggregate costs are changed if the volume of output is decreased or increased by 1 unit. Sunk costs are costs incurred in the past. They are the result of past decisions and cannot be changed by future decisions. The difference in total cost between two alternatives is termed as differential cost. In case the choice of an alternative results in an increase in total cost, such increased costs are known as incremental costs. While assessing the profitability of a proposed change, the incremental costs are matched with the incremental revenue. Opportunity cost refers to an advantage in measurable terms that have foregone on account of not using the facilities in the manner originally planned. Relevant costs are those which change by managerial decision. Irrelevant costs are those which do not get affected by the decision. The elements of cost are material, labor, expenses, and overhead. To obtain the materials that will be converted into the finished product, the manufacturer purchases raw materials. Raw materials are the basic materials and parts used in the manufacturing process. Some raw materials cannot be easily associated with the finished product. These are considered indirect materials. Labor can be direct or indirect. The work of factory employees that can be physically and directly associated with converting raw materials into finished goods is considered direct labor. In contrast, the wages of maintenance people, timekeepers and supervisors are usually identified as indirect labor. Expenses again can be direct or indirect. Expenses such as production royalties to be paid to the holders of manufacturing or patent rights, hire or purchase of certain special machine tools for one-time jobs, etc. This category of cost is termed as direct expenses. Indirect expenses consist of costs that are indirectly associated with the manufacture of the finished product. The term overhead includes indirect material, indirect labor, and indirect expenses. Thus, all indirect costs are overheads. Effectiveness of costing can be understood by the fact that costing helps in identifying those activities that would be profitable for the firm to undertake. When done properly, costing also identifies waste and inefficiency. It supports cost reduction programs and analyzes movements in profits. Needless to say, costing has been quite effective in the estimation and fixing of selling price. By costing, stocks of various organizations are valued and the budgets are developed. Now, one point to note here especially is that the managers have to do proper costing first in order to plan and control various activities under different departments. Costing also evaluates the cost effect of policy decisions. Now let us check if we have understood the various concepts discussed in this lesson clearly. Indirect material is the cost of the thread cannot be conveniently measured for a single unit of the product. Right or wrong? Right. Salary paid to the supervisor is direct labor. Right or wrong? Wrong. Predetermined costs are costs that are determined or estimated in advance to any activity by considering the past events. Right or wrong? Right. Before we end, let us briefly revise what we have studied till so far. Cost accountancy is the combination of both the applications of costing and cost accounting principles, methods, techniques to science, art and practice of cost control and ascertainment of profitability. The scope of the cost accounting could be classified into three major segments, that is, cost ascertainment, cost accounting, and cost control. The methods of costing are normally classified into two major categories, that is, specific order costing and operation costing. The various techniques of costing, nothing but vital tools of ascertaining costs, are uniform costing and marginal costing, historical costing, direct costing, absorption costing, and standard costing. The costs are classified into various categories according to the purpose and requirements of the firm. Some of the most important classifications are according to functions, direct and indirect costs, according to variability, according to controllability, according to normality, according to time, according to planning and control, according to managerial decisions, differentials, incremental or decrement cost, and opportunity cost.